The stock market's been a wild ride lately. One day it looks like we're set for a rally, and the next it feels like we're on the edge of a pullback. So what's really happening? Are we heading for a big rally or another dip? Analysts are split. Some warn of an imminent recession, while others predict a soft landing. With uncertainty all around, it's crucial to ask, how should you position your portfolio? While inflation grabs headlines, employment numbers are often a stronger predictor of downturns. Rising unemployment can lead to decreased consumer spending, shrinking corporate earnings, and ultimately falling stock prices. This pattern was clear during the 2008 financial crisis, when job losses led to a market collapse and recovery was slow. So before we start, if you find value in this video, please support our channel by liking and subscribing for our weekly updates. Now, let's get started. Now, this leads us to the next big question. Should you be buying stocks right now? It's a tricky one, and there's no one-size-fits-all answer. The stock market has already had a decent sell-off, so there may be some good opportunities out there, but there's still the risk of a deeper recession, which could drive prices even lower. Let's take a closer look at some specific sectors and stocks that might be worth your attention. Tech stocks, high risk, high reward. Let's start with the tech sector. Tech stocks have always been known for their volatility, but with companies involved in cloud computing, artificial intelligence, and digital infrastructure, the potential for growth is huge. Number one, Nvidia. Nvidia has been leading the AI revolution, with its stock price currently at $116. The company's valuation has surged in recent years, driven by its pivotal role in AI, gaming, and data centers. However, given its high valuation, any economic downturn could pose a risk to sustaining these highs. Number two, Apple. Apple's stock continues to be strong, backed by massive cash reserves and consistent product demand. Apple is well positioned to endure economic downturns, but a decrease in discretionary spending could impact sales of high-end gadgets. As of now, Apple's stock trades at $178.72. Number three, Amazon and Microsoft. Cloud computing. Cloud services remain critical for businesses, making Amazon and Microsoft more resilient in tough economic conditions. However, their high valuations mean that they are still susceptible to broader market sell-offs. Amazon's stock price sits at $131.23, while Microsoft is trading around $315.28. The tech sector offers high growth potential, driven by AI and cloud services, but remains volatile and vulnerable to economic downturns and market sell-offs due to high valuations. But before we proceed, here's a question for you. With tech stocks booming, do you think the AI revolution is enough to keep these stocks soaring, or is a tech correction around the corner? Comment your thoughts below. Healthcare, a safer bet? If tech stocks feel too risky for your taste, healthcare might be a safer option. Companies like Johnson & Johnson and Pfizer provide essential services that are needed no matter what the economy is doing. This makes healthcare stocks more resilient during downturns. Number one, Johnson & Johnson. Johnson & Johnson, a leader in healthcare, currently trades at $164.01. Its stability comes from essential healthcare services that remain in demand regardless of economic conditions. Number two, Pfizer. Pfizer continues to show resilience, especially with ongoing demand for vaccines and treatments. Its current stock price is $33.64, positioning it as a solid choice for long-term investors. Healthcare stocks offer a safer option compared to tech, as companies in this sector provide essential services that are always in demand, making them more resilient during economic downturns. Energy stocks, a volatile opportunity. Energy stocks, especially those in the oil and gas industry, can be volatile, but they've shown resilience lately. Companies like ExxonMobil have been able to hold their ground due to stable demand for energy. The upside of energy stocks is the potential for solid returns if oil prices rise due to supply constraints. These stocks are: number one, ExxonMobil is benefiting from stable demand for energy with a current stock price of $112.53. Rising oil prices could boost its returns. Number two, NextEra Energy, renewable energy leader. NextEra Energy is trading at $75.48, making it an attractive option for long-term growth as global clean energy investments increase. As you can see, different sectors offer different opportunities and risks. But what if you're more interested in hedging your bets? Let's talk about some strategies that can help you protect your portfolio. But before we proceed, here's a quick question. If you could only hold one stock for the next 10 years, which one would it be and why? Comment your thoughts below. Hedging strategies for uncertain times. To hedge during market downturns, tools like inverse ETFs, which rise when markets fall. For instance, if the S&P 500 drops by 2%, the ETF rises by 2%, and option strategies like puts provide protection by allowing you to sell stocks at a preset price. If you're not comfortable with these complex strategies, holding more cash can offer flexibility during uncertain times, while bonds, especially US Treasury bonds, rise as interest rates fall. Gold, a traditional safe haven, and dividend-paying stocks are also stable options to consider. Balancing is key. Too much hedging can limit gains when markets recover, while too little leaves you exposed to bigger losses. With dividend-paying stocks, you can generate steady income even if prices fluctuate. Ultimately, your strategy should align with your financial goals and risk tolerance. The table provides an insightful look at top stocks across key sectors, comparing their current stock prices, risk levels, and opportunities. In the tech sector, stocks like Nvidia and Apple offer high growth potential, driven by innovations in AI and consistent consumer demand, but come with higher risks, especially during economic downturns. Similarly, Amazon and Microsoft, benefiting from cloud computing, offer resilience but remain vulnerable to market sell-offs. On the other hand, healthcare stocks like Johnson & Johnson and Pfizer are considered safer bets, offering stability due to their essential services, which remain in demand regardless of economic conditions. Energy stocks such as ExxonMobil are well positioned to capitalize on rising oil prices, while renewable energy stocks like NextEra Energy provide long-term growth potential as global investments in clean energy increase. This table underscores the importance of understanding each sector's unique risk and reward dynamics when crafting a diversified portfolio. Preparing for what's next. If you're in the camp that believes a recession is on the way, it's time to think about how you can prepare. Building a diversified portfolio that includes defensive stocks like healthcare and consumer staples can help balance out the risk. Additionally, US Treasury bonds become more attractive during recessions as investors seek safe havens. Another key aspect of preparing for the future is staying informed. In the current economic climate, things can change rapidly. Monitoring global news, market updates, and economic reports can help you make informed decisions. For example, if inflation continues to drop, that could be a positive signal for growth stocks. On the other hand, if unemployment spikes, defensive stocks and bonds might be a safer bet. Keep an eye on interest rate decisions by the Federal Reserve as well. These decisions can have a ripple effect on both the stock and bond markets, so being aware of policy changes is crucial. But if you think the market will bounce back soon, growth stocks in sectors like tech could offer higher returns. Just be cautious. Trying to time the market is always a risky game. Many seasoned investors recommend dollar cost averaging, which means consistently investing a fixed amount into the market over time. This strategy helps smooth out the impact of market volatility by spreading your purchases over a longer period. This can be particularly useful if you believe the market will recover, but want to avoid the risks of trying to buy at the absolute bottom. When positioning your portfolio, it's essential to stay flexible. Markets can change quickly, and having a strategy that allows you to adjust as conditions shift is crucial. For example, keeping some cash on hand to take advantage of buying opportunities during a downturn can be a smart move. At the same time, don't forget about the importance of long-term investing. If you believe in a company's fundamentals, holding through the rough patches can pay off in the end. It's also important to note that periods of volatility are often followed by periods of strong market performance. Historically, markets have always recovered after downturns, though the timing can vary. By staying patient and sticking to your investment plan, you can position yourself to take advantage of the market's eventual recovery. As we wrap up, it's important to note that no one can predict the future of the stock market with certainty. However, by staying informed and diversifying your portfolio, you can navigate uncertain times with greater confidence. Whether we're heading for a hard landing or something else entirely, the key is to remain adaptable. Before we wrap up, here's one last question. What's your boldest prediction for the stock market in 2024? Let us know in the comments below. Thanks for joining us today on Simple Investing Secrets. Remember, this video is for informational purposes only, and it's not financial advice. Be sure to consult a financial advisor before making any investment decisions. And if you found this video helpful, please like, subscribe, and hit that notification bell so you don't miss out on future content. We'll see you in the next video.